Good morning, good afternoon, good evening, folks. How are you doing today? As promised in our daily financial news, we have the one, the only, and yes, the legend, Jonathan Twomley on this morning. How you doing, sir?
I'm doing really well, and Michael, I love your hair.
Oh, thank you very much. I did it to have some fun, and I'm actually having a bet with my students that if we can do 500 deals in a year, I'll dye my hair purple. So I wanted to go just test it out. I wanted to go see what this dyeing hair is all about. So I figure blondes have more
Well,
fun. So hey,
I want to see your purple hair.
yeah,
So I,
me
I hope
too.
your students, I hope your students, win that bet with you.
There you go. We're already at 24 deals in 2 weeks. So
Awesome.
it's how to get started one rental at a time is working. It's fun. But what I want to talk to you about today, and I saved this conversation for you, right? Because I have seven experts. I really pair up the topics. This one is for you because we're both conservative. We both kind of vibe on the economics data. But Jamie Dimon came out. I think it was Monday. It might have been Sunday, and basically said, you know what? JP Morgan is going to stack cash to the tune of already 500 billion, and estimates are 50 billion a month on top of that. So he's not done.
Mm.
And he expects inflation. And when you read that the first time, and if you're just reading the high level and you're not playing chess like Jamie, you're playing checkers, you're like, that doesn't make sense, right? Because the logic holds, you need to repel cash if you expect inflation. But again, there are dominoes or chess moves, and I think Jamie Dimon is telling everybody he expects deals, fire sale prices, kind of in different segments of the market. Am I reading that right, or is Jamie just crazy getting cash when he expects inflation?
I would say Jamie is very late to this party
No.
because because we have already been seeing for quite some time investors like Warren Buffett,
Yeah.
like Sam Zell, and other people have been stockpiling cash for some time, and not a one of them has come out and said, "Oh, because I fear inflation, I'm going to go now take all this cash and put it in something fast because oh my God, inflation."
Yeah.
And the thought process. I mean, I have not talked with Jamie this week. We missed our weekly phone call, but so I don't know exactly what he's thinking, but here's my supposition.
Right.
My supposition is that he believes that the following kind of dominoes will happen.
Yeah.
That inflation will come. Inflation will cause the Fed to raise rates. They'll be forced to raise rates. If they raise rates, asset prices will fall, and there will be discounts to be had that will far exceed whatever they lost on their money in the period of time between now and then, assuming that there is inflation. And the idea is, I mean, listen, when people are getting bent out of shape about 5% inflation,
Mm-hmm.
you know, we actually had 5% inflation back in I think 2013 or something for one quarter,
Mm-hmm.
and like I don't remember anybody saying anything about it. And but now inflation has become politicized, and it's like
Yeah.
there's some people there are a certain number of there's like the inflation fears on one hand, and there's the people who are actually hoping for inflation
Right.
because then it's going to validate their
Opinion.
political position,
You're right.
right? So they're kind of the ones who are like rooting for ruin because they'll be right.
We have a
So
lot of that now. It's
the
like I
country
want
will be
other people to suffer.
that's
Why
right.
is that?
Or even me, like I want to suffer so I can be right, right? And
Wow.
and so, but anyway, I mean, listen, like dialing this back a little bit. Let's just sort of walk. It's just math, right?
Yeah, I
Like,
actually one sec. I actually think there's another step because I think everything you said is correct, but I think there's also a step zero. I think Jamie realizes that there's been more pain incurred over the last 18 months that really hasn't been realized yet. I think he thinks banks have been like kind of kicking the can or extend and pretend. So I actually think he thinks there's a lot of pain that the bill will come due. And then he
yeah,
thinks inflation, and then he thinks higher interest rate, which is going to compound all of that, right? Because if you're already behind and you have a variable interest rate reset coming, you're like, that's okay. Straw that broke my back. I'm done. I'm out.
yeah,
And we
yeah.
just saw that in a retailer, right? 100, I think Washington Heights, or I don't remember what it was, Washington Prime just went BK, right? It's a mall provider that have 100 stores. Went BK this week
Yeah.
or Sunday, not last year, this year. So I think there's a lot more pain that Jamie sees. Other than that, I think you're dead on.
Yeah, and I would agree with that too. I mean, I think it's probably both of those things. I mean,
Yes.
I myself have been looking at assets and seeing uh, recently a couple of foreclosure sales
Hmm.
hitting in multifamily, hitting
Interesting.
Crexy and stuff because it's happening, right? I mean, there are people who really suffered during COVID and they couldn't make it, and they've been foreclosed on. And so that's one part of it. I think people were stockpiling cash. I mean, listen, people were stockpiling cash 2 years ago already,
Hmm.
looking at how high the markets had gotten, and the Sam Zell, Warren Buffett. I mean, they were talking 2017, 2018, 2019 about stockpiling cash before
Yeah.
COVID ever hit. They're probably as surprised as anybody that COVID didn't create the buying opportunity that they were waiting for,
Hmm.
because of all the cash that got pumped into the
Yeah,
system.
Warren
But
Buffett was licking his chops because he wanted to do another deal with Goldman Sachs and all these
oh
other
yeah,
players,
I mean,
right?
so that's the but listen, so if
Yeah.
uh, but just back to the so then we've got this sort of inflation
Hmm.
fear, quote unquote, layered on top of it.
Hmm.
But I think my view is that I still really believe that the inflation is transitory. Like it's suddenly the economy has become unleashed after
Yeah.
18 months of inactivity. Plus, you've got all these supply chain issues that have happened,
Hmm.
right? There's a lot of demand now that's going to cause inflation. But if the market still works, that means that all those companies are going to ramp up. They're
Hmm.
going to build more stuff, make more stuff, and then in 6 months' time, I mean, this is not a prediction. I'm just saying in 6 months' time we could be talking about a glut of inventories on the market for
Certain
consumer
segments, I
goods,
agree.
right?
Yeah, I think
Yeah,
history is pretty common here, right? Manufacturers. I mean, I just did in my daily financial news. We talked about cars, both Ford and GM. Get
yeah,
this: they both see higher inflation, input costs, right? I think it was GM said $3 billion in input costs. But
mm,
oh, by the way, they expect to make more money. What does that mean? That means they have pricing power because of limited
right,
supply, right? Demand
yeah,
supply. What are they going to do? Every time they just build more because they do. That's what they do. They're car
right,
manufacturers.
and
And
yeah,
eventually the demand will go away. They'll have too many cars and be like, oops.
yeah, and then you see what you see periodically. The car industry is always like this. They're always they they overreact in every direction. I
Hmm.
mean, listen. I mean, it's not like I mean, it's hard. They're experts at trying to predict the market, and they get it wrong all the time. So
Exactly.
this is not easy. This is not easy to do,
Hmm.
but you see this a lot. Like if you guys start seeing those, and you see this like usually at least once a year, but you get these like suddenly like zero down payment, 0%
Yep.
financing offers, for the first year or whatever.
Hmm.
That's because they've got too many cars on the lot. They've got to move them, right?
Yeah.
And so this is going to happen too. And I think there's no reason to believe that we've entered some like phase shift
Right.
where like not enough lumber is going to get produced from now on forever,
Right.
right?
Right. Right. Right.
Or like or whatever it is, auto parts or copper wire or whatever the hell it is that people are that it's now there are these supply chain blockages because they
Hmm.
haven't been making the stuff or as much of it for 18 months. Now they're going to go into overdrive producing this stuff, and that causes price dislocations.
Hmm.
But we just know the law of supply and demand has not yet been repealed.
Yeah, exactly. It still works every
you
time.
know yeah, I mean, there are some people who don't want to adhere to that law, like
Eh,
they think that it doesn't apply to them.
yeah. They're
Law of
unique.
supply
Yeah.
and demand doesn't
Sure.
apply to me.
Yeah.
But
Crazy.
it'll the standard response to this will be that they will produce too much of it. I mean, look at PPE. PPE is a great example of this. You remember what happened when COVID broke out?
Hmm.
Nobody could get any PPE,
Right.
right? And
Masks
then
and
what
gloves
happened
and all that.
was
Yep.
I know like 10 people easily who went into the PPE business when COVID started,
Mm.
right? And now they're all out of business
Yeah.
because they weren't the only 10 who went into it. There were like thousands and thousands and thousands of businesses that went into producing PPE
Hmm.
and oversupplied the market, right?
Yeah.
Every, I have a friend who helps uh, New York State promote its wine, beer, and distilled spirits industry, right?
Okay.
That's his job. And he told me last summer when I said, what's going on with the wine industry? He said, well, all of the distilleries have all converted into producing hand sanitizer,
Oh, wow.
right? So basically everybody was producing hand sanitizer. Remember, you couldn't get
Oh,
hand
yeah.
sanitizer
I
for
remember.
a
Yeah.
while. Then all of a sudden it's like everywhere, right? This is the same thing that's going to happen with everything else. If the
Hmm.
demand is there, the manufacturers are going to make more of it.
Hmm.
And then eventually they'll make so much of it that they're going to have to cut prices because they made too much of it. And that's
Agreed.
just the way it works.
So
So
so let's
I'm not
let's step
worried about
back.
this, but
Yeah, let's step back from this and go back to
yeah,
Jamie
I wanted
Dimon
to get
raising
back to the,
cash. There you go.
yes,
So
yeah.
what is the
Okay,
average
that was where I
investor,
was about
right?
to go with it.
Okay, let's
What's
go.
that?
I was
Yeah,
going to
so now I
say,
was about to go. I was about to go back to this, but anyway, so let's just say that, you know, like right now we've hit 5% inflation and
mhm,
people are losing their minds, right?
yeah,
Now let's just say it goes to 10% and people
okay,
really lose their minds,
all
right?
right.
What is going to happen when inflation hits 10%? Well, the
Ooh,
Fed is going to put the brakes on the economy by raising interest rates by a whole bunch all at once, right? Because that's the only way that they're going to be able to tame inflation.
hmm,
What's going to happen if they raise interest rates? Well, the first thing is that the stock market is going to, if not collapse, it's going to have a major correction,
yeah,
right?
yeah, the correction without question. Yes.
Right. And in the property markets, what's going to happen? Well, if interest rates go up that high, it's going to cause the multifamily market to grind to a halt because
Yep.
everybody is buying property at razor thin margins because debt is so cheap.
Hmm.
But if interest rates go, rise to 8 to 10% to try to tame inflation, like suddenly the amount, your what's called your debt constant, which is the percentage of your debt payment, right, versus your NOI, your net income, right? That's how the banks measure like your ability to repay, right? That is your debt constant is going to rise because the interest rate has gone up.
Hmm.
That is going to, when they have to then say your NOI must be 1.25 times your debt service. If your debt service goes up by a quarter, by 25%, right? If that NOI doesn't go up by, 1.25x of that, you don't get the loan. So they're going to
Yep.
cut your proceeds, right? And so suddenly you're going to have to go in at 60% leverage, 55% leverage, right?
Yeah.
And there are not a lot of people out there who can do that, right?
Mm-mm.
Right. So what's going to happen? The price of that stuff is going to fall, and it won't affect you if you have if you have long-term debt locked in and you don't have to refinance and you're cash flowing. It is not going to affect you at all.
Hmm.
But it is going to affect two types of people. One is the people who have to refinance
Yep.
for whatever reason.
No question.
Now suddenly they're going to be in a world of pain because they're going to have to come up with a lot of cash to cover the deficit, right? And uh, especially if they haven't had much NOI growth or rent growth or what have you, right?
Hmm. Hmm.
Uh, for your deep pocketed investors, this won't be a problem, but for your syndicators who are having to now go to 100 investors who each put in 50,000 bucks and say, you've got to
Whoops.
give me another 10,000 or we're going to lose this, right?
Yeah.
You know that not all those people are going to be having
Mm.
the 10,000 plus, the other, I mean, there's a lot of pieces of this chain of causation, but if interest rates rise that much, people's stock portfolios are going to tank. So there's going to be a lot of investors saying, I don't have the
I'm
money,
scared.
or they're
Yep.
nervous. I'm scared. Like I'm gonna, dilute me. That's fine, right? Because I don't
Yeah.
want to part with another $10,000 right now. So those people they'll be in big trouble on one hand and
Yep.
looking to exit, and the other will be the people who who took the view that interest rates are going to be low forever. So therefore, I'm going to take variable rate. I'm going to take an
Oh,
adjustable rate mortgage because
yes.
I'm making a bet that interest rates are going to stay low. And for
Hmm.
people like those, when their interest rates shoot to 10%, they're basically, if they're not in foreclosure, outright, they're
Hmm.
going to be in cash management, which means the banks are just going to take over their bank accounts and basically take all their cash.
Yeah.
So it's going to be it. So all those things will happen, and excuse me, as a result of those things happening, there will be bargains in the market.
Absolutely.
And here's the thing: this is taking a very long time to get here, but let's imagine there you have 10% inflation, right? And it takes a year for the Fed to tame it, and you're sitting in cash. But the Fed tames it, and it causes asset prices to drop by 25%. we've already been through in a previous
Oh yeah,
episode
I've been there.
about how quickly asset prices can drop with just a little bit of change
Little.
in the cap rate, right?
Yeah, remember.
Now, so it is not uncommon at all for asset prices to drop 25%. In fact, typically in the property markets, when there's a correction, asset prices drop 30% from the previous peak.
Yeah.
So basically, two things can happen. If you put all your money, if you don't have some hold back, right, because you're afraid of inflation, right, here's what's going to happen to you. You'll put that money in at the top of the market,
Hmm.
right? You will then lose 30% of the value of that, which may mean it might be unrealized if you don't have to sell, but it might be realized too,
Hmm.
right? Plus, you miss out on now essentially a delta of 20%, right? You lost 10% to inflation, but you gained 20 more percent. You gained
Yeah.
30% on the discount, and you've now missed that opportunity because you have no cash.
Yeah.
That is what Jamie Dimon is thinking about. That is what Buffett is thinking about. That is what Sam Zell is thinking about. And there's a guy that many of you have never heard of before named Seth Klarman, who's probably even a better investor than Warren Buffett. And his strategy forever, for 3 decades, has been basically being 30 to 50% cash all the time.
Wow.
All the time. He's always in cash, 30 to 50%. The reason is because you make more money on those huge wins, right, than you
Hmm.
do by the little dribbly kind of going up all the time and then losing it
Whack.
all when there's a crash, right?
Yeah.
And the thing is, when you buy at a big discount, you are building in such a margin of safety that you don't care about the crash. It doesn't affect you,
Exactly.
right?
Yeah.
So that's how Seth Klarman has been so successful, because he's in cash all the time, right?
Yeah.
So these people who are like fearing a temporary bout of inflation, or unrealistically thinking that we're going to have 10% inflation like forever,
Hmm.
right? Somehow that the Fed is not going to step in. I mean, we've been here before. You and I are old enough
Oh yeah, I
to
remember.
remember 20% interest rates,
I do.
right? The Fed will tame inflation if it has to,
Hmm.
because otherwise there'll be political chaos, right?
Yeah,
So
exactly.
um,
Yeah.
it's not going to. It's so don't be one of those. I'm not saying don't invest anything, be all in cash. What I'm saying
No.
is you gotta hedge. And so hedging means doing some investing, but also making sure that you've got that cash on the side, that dry powder, to take advantage of these opportunities when they come.
Yeah.
So
The last
that's
thing
important.
the last thing I'll say on this, because I speak to lots of single family home investors, and I've been very clear, right? I think we did a video last week, or maybe I did a live on this, that actually, I think we did, right? That multifamily pain is out there because of the debt structure, right? The
Mhm.
interest rates can't be locked for 30 years. So in the single family space, if we used your analogy, if interest rates went to 10%, there'd be pain in single family without question. But again, if you're buying with the one rental at a time mindset, you won't be hurt, right? Because it cash flows the day you buy it. You have
Yeah.
30-year fixed rate debt, but still around you, the market will soften, because what happens at 10% interest rate is affordability will get freaking crushed.
Yeah.
And I believe affordability in the single family housing market is the metric, the North Star, for when the market is in trouble. And, my market today is about 44 or 45 on a scale of 1 to 100, which means it's affordable, right? It's a problem at 20.
Mm.
But if interest rates go up to 10% on the current median price, it will freaking crash to 12 or 13. It will be a problem. So single
Yeah.
family purchases will certainly slow down. Builders will have to slow down. There will be pain in single family, but if you're a landlord and you have 30-year fixed rate debt and a cash flow day one, you can hold through the term. And oh, by the way, get to buy some more stuff.
Yeah. I mean, if you long-term debt is just really, really helpful, right? I
Yes.
mean, because it just, and so if you're doing multifamily, you really want to take as long-term debt as you can get, which is typically 10, although, there you can sometimes get 12 and 15%,
Hmm.
sorry, 15-year debt. Um, so if you can get it, that's great,
Yeah.
because you reduce that risk a lot, and you have a lot of time
Yeah.
to 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 pay down your debt, and also to build rent growth, that over time is going to increase that delta. So when you have to refinance,
Yeah.
you've got plenty of margin. But the real
Yeah.
issue, the real sort of scary thing in this inflation scenario is actually the uh, the value add,
Oh God.
so the 2 to 3 year window, where you've got basically a bridge loan
Yeah.
that,
IO period. Oh,
with, yeah, and it's a high interest bridge loan already,
yeah.
and and you've got to refinance that in a couple of years. Now I know oftentimes those have like a couple of years of extension built into them, so you can try to time things a little bit better, and maybe you'll be able to ride it out. But it still just adds more risk. And if you're going in a situation where you know you're buying at a 4.5 cap because you believe that you can invest this money and raise it to an 8 cap,
Hmm.
and then if inflation spikes and the Fed basically creates a recession by raising interest rates, you may not get those rents, and it just may not work out. So
Yeah.
just
Be
really
careful.
be careful. Yeah, be careful, and
Yeah.
don't believe that cash has cooties. Cash does not have cooties.
I
Cash
agree.
Cash is an option on opportunity. That's
I
what it
love
is.
that.
Cash
Cash
is an
is
option on opportunity.
I love that. Yeah, folks. So again, the big players have been stacking cash for a while. Jamie Dimon just came out publicly and, kind of shook the world, right? Stacking cash and expects inflation, but it's because he's playing chess, not checkers. Jonathan, how can people follow you and be a part of your world?
Yeah. So if you want to reach out to me, you can always join my Facebook group, which is the Multifamily Investment Community. You can also go to my website, which is twobridgesmanagement.com. It's probably actually easier to search for Two Bridges Asset Management in Google than it is for me to read the URL to you. So
There you go.
yeah, just search for Two Bridges Asset Management, and it'll show you how you can
Awesome.
get on my list.
Folks, and again, we have a playlist below. I just spent some money cleaning up my descriptions. Jonathan and I have been talking for almost 2 years now, I believe. So there's hundreds of hours of
Wow.
material to listen to. So Jonathan, thank you very much.
You're welcome.